Good afternoon, everybody. My name is Omar Qureshi. I think most of you on this call know who I am, but if you don't, I am the managing partner of Hightower St. Louis Wealth Advisors. I also have the misfortune these days of overseeing our investment strategy in these crazy times. So this is a little bit new for us to do kind of an on-demand webinar based on what's happening in the market, but things have been just that crazy, and I know a lot of people have a lot of questions and concerns about what's going on. So we thought we'd leverage Zoom to be able to share our thoughts on what's going on and what that might mean for portfolios, and for you guys specifically as well. As hopefully you can see on the title slide, you are more than welcome and certainly encouraged to ask questions. You can do it in one of two ways. First, send an email to q&a@hightowerstl.com. You can also send a text message from your phone to 314-593-2460. Uh, we are recording this, and pending compliance approval, we'll make a recording available uh, sometime after this. All right. So without further ado, let's talk about just from a high level, what's going on. So I think the most important part of what we see here is that the outlook for the U.S. economy has deteriorated quite substantially from the beginning of the year. Um, Nearly all of that, can be traced to the administration, both policies and behaviors. We'll talk about both of those today. So, you've seen the headlines: Doge, layoffs, immigration, tariffs, and certainly the list doesn't end there. And so we talk about, this time being an uncertain time. Uncertainty isn't just kind of a feeling. Uncertainty changes the way that businesses and consumers behave, and importantly, in this context, economically behave. So is- you know, the longer uncertainty persists too, the greater these effects are felt. And so we find ourselves with the market really unable to determine, which way to go, up or down. And we've certainly seen both. We've seen that in the stock market, which usually gets the most amount of press, and most of you probably watch. Uh, Maybe even more worrisome, we've seen that in the bond market, particularly the US Treasury market, which is sort of the underpinning of the global financial system, and quote unquote the risk-free asset. And so when you see the bond market come unhinged, that's a lot more worrisome than even the stock market, though the stock market might feel more unpleasant. Um, so, what we're looking at is a much higher probability of recession than, where we woke up January 1st. Um, and if that wasn't bad enough, we are also looking towards inflation getting worse, meaning prices increasing. So we'll talk about and show some charts of what that looks like. And when you throw these two things together, some of you may have lived through this. We talk about a condition called stagflation, where the economy is stagnant or shrinking, and yet we have prices going up, which is the inflation part, so stagflation. Um, this is a very, very difficult environment for portfolios, because both stocks tend to do poorly because of the economic aspect of it, and bonds also tend to do poorly. And these are, of course, just generalizations. These are broad categories. Um, Bonds do poorly, when interest rates are going up. Um, yes, as always, we encourage our clients to take a long-term view, um, to stay diversified, stick with the plan. The planning that we do, and somebody actually asked a question, already about the Monte Carlo simulations that we do. Um, those are very, very robust to include market conditions like this. I know Ryan and I manually looked at all the historical data, and we took it all the way back to what's considered good data, early 1920s. So this takes the Roaring '20s, the Depression, and everything since into our assumptions. So that's a really good metric to make sure that you continue to be on track for your goals in the context of some shaky markets. Um, so let's talk about where we've been, or sort of where we were coming into the beginning of this year. Um, U.S. unemployment was just a tinge over 4%. If you look back 75 years, that's going to be one of your best. It's not quite the best, but it's pretty darn close. So, that means people are working. And in America, when you're working, um, you spend money. And we know that consumer spending accounts for about 2/3 to 70% of the U.S. economy. So with close to full employment, consumer spending is very, very strong. As of year end, it was over $20 trillion. So pretty hefty amount that we do collectively. Um, and and the last bit I want to show or talk about is the S&P 500. I would just take the largest 500 companies in America, the blue chip companies. Um, Operating profit margins at year end were at about 14.5%, which is also near record levels. So to translate that, companies are making absolute gobs of money, some of the best profit margins that we've ever seen. So if you woke up on January 1st and you looked at this set of data, you'd probably say to yourself, hey, this is a backdrop to a decent year in markets. A lot of things going pretty well. Strong economy, strong employment, and strong profitability for companies generally would be considered a recipe for stocks to have a decent year. Clearly, that's not where we've sort of ended up. And why? Well, on January 20th, Donald J. Trump was elected to his second term in office, and that's when the fireworks started. So there's obviously a whole lot to be discussed here around President Trump. I like to, break it into two parts to get my brain around it. One is to talk about policy. The other is to talk about personality. And I think they both have a huge influence on what we've seen so far this year. Um, Now, I will say, policy, some days I scratch my head trying to figure out what the actual long-term objectives are, because things are changing so much. Um, it's it's hard to assume that one has a plan when you sort of change the plan every day or every week. So the policy that I reference is my best guess of what we're getting here. So let's talk about this. Trump is obviously espousing a message of populism, ironically, not dissimilar from a Bernie Sanders in 2016. Um, and that's about restoring the middle class in the United States. Obviously, the US shipped a lot of manufacturing overseas, starting in the 1970s and beyond, and sort of, gutted the middle class. Wages in the middle classes stagnated. And so Trump views this as something he wants to try and fix. Um, as a country, we import a lot more than we export. And again, Trump views this as a negative, and would like to bring back manufacturing to the United States and eliminate trade deficits. That's where you get into sort of tariff policy. Um, Cut the federal deficit. This is one, hey, I think every American should be behind. the government is on a runway at borrowing $2 trillion a year. That simply is not sustainable. And obviously this needs to be changed. That's when you kind of cross into how do we change it, and the behaviors around changing it that people may have disagreements around. Closing the borders was a big priority. We've seen some activity from President Trump on this, although I would argue we haven't really seen the full kahuna, as he's been focused on tariffs and then I think in the tax policy first. But we have seen the deportation of some illegal immigrants. We've seen the deportation of some, people who are legally here otherwise. And last, and maybe this is a comment I shouldn't put on here, a little bit or quite a lot, a bit of retribution for really anybody he perceived has wronged him. We've seen a lot of activity on that front. On the personality side, look, you don't need me to tell you any of these things. I think it's best described as chaotic. He's certainly unfiltered, disruptive, bold. You can insert your own adjectives there. But I think, the important part for this conversation is, if you woke up on January 21st and President Trump said, here's my agenda for the year. These are the 10 things I'm going to accomplish. I'm going to do them in these order, and here's what they're going to look like. I think the market will largely digest that. I've always said, and you guys have probably heard me say, markets can deal with good news, markets can deal with bad news, but markets cannot deal with news they don't know. So when you have the news flow and the plans and the policies and the tariffs and all of the different things, every day you wake up and it's sort of something new. The market is going to freak out about that, and that's exactly what we've seen. People ask me what could make the situation better. I would just simply answer with clarity. It's you may agree or disagree with the policies and the politics, but if we had clarity, that would go a long way to settling things down. But we just can't seem to get that. So what's happened as a result of what we've seen this year? I've got a bunch of charts here. We're going to do a lot of charts from here on in. The first one is going to be a global policy uncertainty metric. What you can see here at the far right of the graph is that uncertainty, and this is primarily from news articles, economic indicators, economic forecasts that come into this, is considerably higher than any time we've seen going back over 25 years. So that includes COVID, that includes the financial crisis as well. So when we say unprecedented uncertainty, that feels like something the media spits out there. It is actually objectively true today. And as I alluded to earlier, that uncertainty translates to beyond just a feeling. It translates into behaviors that then affect the economy. And so let's go through a couple of the ways that this uncertainty has crept in. So the next couple of slides are from the University of Michigan surveys. They do consumer sentiment surveys and have for some time. The chart here is divvied up into a blue line, which is consumers with income of less than $100,000 per year. And the green line is consumers with income greater than $100,000. This chart goes back to 1990, so we're looking at 30 plus years of data here, and we're at pretty much the lowest level of sentiment, just how people are feeling, about the economy in this data set. So people are feeling lousy. People are worried about losing their jobs. So up to record highs or near record highs now in the percentage of people who are worried about unemployment increasing in this country. And inflation expectations are skyrocketing, quite frankly. Many different ways to view this, by the way. This one is a little bit stronger than some other metrics that we look at. But 12-month inflation expectations going up to over 6.5%, and then inflation expectations in 5 to 10 years from now also going up quite a bit to about 4.5%. Um, Most of this, I think, is a reaction to the tariff conversation, right? Tariffs are effectively a tax, and either the producer of the good needs to pay the tax, or the consumer of the good needs to pay the tax. So if this tax is passed on to the consumer, then prices go up, and hence inflation, right? That definition of inflation is merely prices going up. Um, it's no better, by the way, if a company pays for it. Companies will ultimately, especially in a dynamic economy like ours, um, find ways to cut costs elsewhere. Usually, a company's biggest cost is labor. So if companies are absorbing tariffs, likely to lead to higher unemployment, which of course is also bad for the economy. Inflation expectations, I want to also point out, are a self-fulfilling prophecy. That's the big fear here, that if you expect inflation to go up, you're more likely to consume more goods now than later, with that notion that they'd be more expensive if you waited. So you actually put more demand in the near term, and then you actually drive prices up by acting kind of rationally in this thought. Um, I'll also say that inflation, can be impacted by some of uh, Trump's other policies, kind of related to tariffs, but thinking about this notion of bringing manufacturing back to the United States. I think we can separate bringing back manufacturing of critical goods and supplies to the United States. I think everybody'd be in favor of that. Certainly, we learned from our experience during COVID that we didn't really make anything that we really needed, all the way down to my coworkers will laugh at me, toilet paper. All of that stuff is imported. So there's a need probably to make a bunch of stuff, pharmaceuticals, et cetera, domestically. Um, but to the extent we make other things here, and we'll talk about this in a little bit, the average wage in the United States, particularly like a union manufacturing worker, is quite a bit higher than what we're going to see overseas. The average hourly wage in Vietnam, for example, and there's really no benefits to be discussed, is about $3 an hour. So making stuff in the United States, by definition, is going to cost more than making it somewhere else, thus the inflationary pressures. We'll also talk about the number of workers we have available. We don't have enough, is the quick version, to actually take those jobs, even if we were to bring them back. So we'll get into that in some more detail. So on the business end of things, we're looking at CapEx, which stands for capital expenditures. These are expenses that large projects that businesses would do. The bar in red shows the percentage in any month that CEOs planned on a cut in CapEx. So started the year just at about 12%. In April, now we're down to 41% plan less capital expenditures. So, we really haven't even decided on half of the policies Trump has talked about. And you can already see the impact of how consumers might change their decisions based on their outlooks, and businesses will change, their behavior as well. CapEx is incredibly important. It's kind of like consumer spending, is a huge driver of the economy. So without CapEx, you can bet that the economy will shrink. This is the model that one of our research provider provides, that looks at CapEx as an input in terms of investment into the economy. and ties it to GDP, it's a pretty good proxy, a really good fit to show that if CapEx uh, is predicted to decline, you can expect GDP to decline as well, which would ultimately give you that definition of a recession. The stock market also really doesn't know what to do with this. So this is a chart of the first quarter 2025 consensus earnings per share for the S&P 500. So that's a mouthful. It's what all S&P 500 companies are expected to earn in dollar terms for the first quarter. And you can see that given all of the uncertainty, and again, even in light of the fact that no actual policies have gone fully into effect yet to keep, flip-flopping, earnings expectations are going down, right? Needless to say, the stock market doesn't uh, doesn't like that, right? Ultimately, the stock market tends to go up when earnings are going up, and the stock market tends to go down when earnings are going down. I think there's a lot of confusion amongst S&P companies as to what to actually guide for earnings. I'll give an example of United Airlines that gave two sets of guidance. They said, well, here's everything we think will happen in our earnings if things kind of stay the same. And then here's an alternate scenario where if a lot of these things go through as discussed, here's that set of earnings, which is quite a bit different from that previous forecast. So companies don't know what to do with this information either. And keep in mind that the tariffs are a two-way street. Yes, they tax imports, but then you see retaliatory tariffs come into the United States. Um, and S&P 500 companies earn about 40% of their revenue from overseas, so a really large chunk coming from abroad to impact earnings. And I think there's also sort of a reputational hit that we've been taking as a country, and that our companies, will be held guilty by association. We'll show some charts of that in a sec. Um, so let's kind of deviate from maybe the current market conditions, and talk about, what is it behind Trump's notion, that we should bring manufacturing back to the United States, and I'll accept out of that critical supply chains, which should be brought back. So this is a chart that shows the trade balance, or in this case, maybe the trade imbalance. And it's just net exports. So what we export and what we import, and that difference. And you can see starting in the 1970s and then really picking up steam in the 80s, 90s, 2000s, our country started importing quite a bit more goods than we exported. Um, Lots of factors behind this, by the way. Telecommunications, globalization, all the way back to Nixon opening up China. Lots of reasons why we were able to find cheaper places to, make the products that we consumed. Um, and that led to this imbalance. Well, our economy prior to that had a pretty stable trade balance. You can see these charts of the 50s and 60s, and we made a lot of stuff in this country, right? A lot of manufacturing. Post World War II, right? We saw an economic boom, um, and there were a lot of middle class jobs available within the manufacturing sector, and that began to change, right? And you get sort of the Rust Belt cities. Where plants and factories and mills and the like, and we shipped that stuff overseas, and so there was a lot of people out of jobs, a lot of cities that were hurt, and wages in inflation adjusted terms at best stagnated, and by some metrics actually declined, and sort of hurt the middle class of America. And I think on the surface, that's sort of, Trump's perspective here is, well, if we can undo this and bring back jobs to America, we can have a more robust middle class and a stronger country, I think is the notion. Um, I want to point out that, us sending manufacturing overseas isn't just, universally a bad thing. One of the consequences of us sending so many US dollars overseas is a lot of those dollars get recycled back into the United States. So into our stocks, into our treasuries, into corporate bonds, into property, into companies. So that's, foreign direct investment effectively back into this country. So it's not like we ship the money off and it's never seen from again. The US has been the main destination of of capital in the world because of the dynamics of our economy, because of just the fact that we're the largest consumer in the world and we send dollars everywhere, and those dollars find their way back to the United States. Um, what we've started to see, and it's early days, just in the last couple of months, is really a cessation of money coming back into this country under this kind of chaotic environment. Um, so we're seeing a lot more dollars stay overseas. You've actually seen foreign stock markets do quite well. I think those two things are related, given that capital is not coming here. But we are quickly becoming an unwelcome destination for capital because of one, the actions that have been taken, but two, the unpredictability of what we might do. Um, We've also seen, if anybody's been watching, gold hit a record high. A joke, it's 1,000-year high for gold. A lot of that is foreign central banks are diversifying more and more into gold, or probably back into gold, I should say, out of treasury markets, being not comfortable with what's happening to treasury. So as we pursue these policies, there's certainly knock-on effects that will have implications within our own economy and certainly elsewhere. Um, just some, tangible evidence of this. When you look at the number of Europeans traveling to the U.S., and these charts go back 2 years, pick a country, it's fallen off the map, right? A lot of this has to do with kind of the way that we've been treating tourists coming to this country with maybe not the perfect paperwork, or certainly people who are here legally that have not been afforded due process rights. And so tourism, needless to say, is a massive piece of our economy as well. And that's sort of cratering under the current dynamics as well. Um, so I want to touch on a different lens of bringing back manufacturing to this country, and I want to talk through a statistic. It's the green line on here. It's called the labor force participation rate. So these are stats tracked by the federal government. And just to explain what this means, let's look at the blue line first. That is the civilian labor force in thousands of persons. So that's about 165 million people in this pool. Those are folks 18 and up. Who are not in the military, who are not incarcerated, who conceivably could take a job in this country or who would want a job. Okay, so because our population has been growing, this blue line has been growing over time. It's been slowing just because population growth has been slowing, and demographics, certainly play a big impact here. But when you look at the green line, The green line is the labor force as a percentage of the US population. That's been in decline since about 1999, meaning there are fewer workers to support the economy relative to 25 years ago. You can see the massive dip during COVID where people removed themselves from the labor force. So this could be for healthcare reasons, or it could have been a dual income household where somebody had to stay home for childcare needs. Um, and the labor force has not recovered to uh, to a pre-COVID level still. Um, and so when we talk about this notion of bringing back quote unquote jobs to the United States for manufacturing purposes, um, I make the claim that there really isn't the number of workers available to take these jobs. And in fact, if you look at a related statistic called the JOLT survey, which just talks about how many jobs there are open in the US economy, that is greater than the number of unemployed people. So bringing back manufacturing to this country maybe sounds good on paper until you realize we actually don't have any of the workers to take these jobs, right? So that's highly inflationary as well because workers will demand much higher wages because there's going to be a lot more competition and demand for them. But we don't have a whole pool of people sitting around waiting to take a manufacturing job today. And if we did, they're working somewhere else, so they'd leave a job by definition to take one. So, uh, demographically, the idea just doesn't really make any sense. I want to point out a great irony as well as Trump, gets going on his immigration policies and illegal immigration. Um, in the past 5 years, 100% of the increase in the labor force are from foreign-born people. Native-born people account for exactly zero of the increase in the labor force. And so there's, varied estimates of the number of illegal immigrants in this country. I just used the round number of 10 million, could be more, could be less. If conceivably they would all be kicked out, we would have a major, major issue in the labor force, right? We'd cut 10 million people out. That would be highly inflationary. And industries, agriculture is number one. 42% of agricultural workers are illegal immigrants. The second one is construction workers. I think it's something like 37%. Um, so at a time where we need people to come to this country more than ever, we're starting to look at policies of how do we get rid of them. And this is just terribly bad news for the economy. Okay. Um, so I'm going to finish up here just on some portfolio implications, and then I'll look to see if there's any questions. Again, email Q&A@hightowerstl.com or text 314-593-2460, and I will check for questions. Um, so market volatility. Um, I often say that market volatility is the price of admissions to long-term handsome rates of returns in a portfolio. Okay. Um, we regularly see declines of 5% or more, a couple times per year. 10% a year happens pretty much every year. 15% or more once every 3 years, um, and so on and so forth. I want to, I don't certainly don't want to scare anybody, but uh, we've seen volatility in the kind of 10 to 12% downside range year to date. We've seen some big up moves, seen some big down moves. What I'm thinking is that this economic environment is not going to improve anytime soon unless Trump can deliver some clarity on policy really quickly. But I think this is looking more and more at risk of a recessionary environment. Now, there's sort of technical recessions that aren't too bad, and then there's very deep recessions. I think time will need to tell on this one which one we may see. I think it's going to be a function primarily of tariff policy. Um, you know, I think if there's any reason for optimism here, whether Trump wants to admit this or not, when the bond market started to become unhinged, and it wasn't the stock market, that's when Trump paused the tariffs for that 90-day period. Now he's anticipating signing 90 countries to 90 deals. I'm very skeptical about this because trade deals on average take about 18 months historically to get done. So to get 90 and 90 seems a little bit unrealistic, but we'll see what we get. So if we go back to those tariffs as were proposed on Liberation Day, I use quote unquote Liberation Day, where we got liberated from our money. If we go back to those, this is really bad news. If we get something a lot lighter than that, much lower tariffs, then I think we're in much better shape. Um, and I should keep in mind, these numbers are if you are 100% in equities, which I don't think many folks are. The more diversified you are, the better you'll fare relative to these numbers. Um, and when we look back in history, and we don't even have to look back far, we can look at the COVID declines, we can look at the financial crisis, we can look at the tech bubble. Most of you, experienced a lot of those periods. Yes, they're absolutely miserable. They are painful, but if they're managed properly, they eventually become blips in the rearview mirror. But that certainly takes time. So a lot more time has been spent in bull markets than in bear markets. Bear markets tend to be sharp and severe and more short in duration. Um, we always talk about this notion of buy low, sell high being kind of the best investment strategy. Seems obvious when things are kind of calm and cool in markets. Um, but when we get emotional about it, and that's what this kind of busy looking chart shows, is if you invest in peaks of consumer sentiment, or if you invest in troughs of consumer sentiment, you get two wildly different results. So on average, this goes back to the 1970s. If you invest when everybody's giddy and happy about markets and happy to take risk, your 12-month forward-looking return is just about 4%. If you invest at the troughs when things are arguably the darkest and you feel worst about things, your forward-looking return is up about 25%. So good to be a contrarian in markets historically, to be sure. Um, so, what do we do about this? What are just some practical tips? Um, Portfolios that include, diversity, as I mentioned. So what does that look like? Value stocks. So we've spent a couple of years where everybody's been enamored with super high growth, AI, really kind of expensive from a valuation basis growth stocks. Those will tend to get hit the hardest in a market downturn because they have the most to give up because they had the frothiest sentiment. Sometimes they have the lightest earnings. So the opposite of that are value stocks. These tend to be your most boring type of industries and names. Could be in could be in oil, could be in finance, could be in some types of pharmaceutical stocks. Your more traditional, non-high tech kind of industries. Precious metals, certainly if you've talked to me, I've talked to you about precious metal exposure. Gold and silver really is what I'm talking about here, and the associated mining stocks. We have exposure in portfolios. If you've had those types of things, you've held up significantly better than the overall market averages. Would think that that will continue to be the case as we go forward. Um, I think you can, I didn't put it on here, but you can also extend um, advice around the types of bonds that you own, fixed income. So you heard me say a couple times today that inflation and interest rates going up are negative for bonds. Or what I'm really talking about are treasury bonds, specifically longer term or longer duration treasury bonds. Um, those tend not to do well in an inflationary environment. You can go back to 2022 as your example of how those behaved. So, when we say bonds, that's a very wide category. And so there's a lot of types of bonds, short duration bonds, for example, that aren't as sensitive to inflation and interest rates as those longer duration bonds. So there's places to go there. Um, we obviously go through a lot of planning. That planning comes with stress testing. What's ultimately the most important, and that's you achieving your goals, typically are tied to some level of spending for some objective. Um, so, you know, uh, reviewing that, making sure that your goals are well elucidated and they're kind of tracked, and we can do the stress testing for you. Um, it never hurts, obviously, to review your portfolio to make sure you're comfortable with the risk level that's in your portfolio. I think this is a ideal time to reflect on that to make sure you're comfortable, and we have the tools to illustrate how your portfolio should fare in both up and down markets. So working with your advisor to kind of review those, I think makes sense. Um, if you're a long-term investor, which most of you are, you should keep that long-term in mind. And Unfortunately, with some of this stuff is a little bit of grin and bear it to the long term. However, if you have short-term spending needs, uh, those need to be kept safe. This is not a time to be a hero and try and buy the dip with some money that you might need in the next year or two. So I'd encourage you, if you have defined objectives in the near term, that those are out of harm's way, given what may occur in markets. And a couple other planning strategies. If you're RMD eligible, in other words, you need to take money out of your IRAs, you could consider accelerating those, taking those sooner, rather than waiting to take them out, perhaps when the market is lower. Similarly, with charitable donations, if you're donating stock, doing so while they're at a higher value could be considered again versus what they may be worth down the road. All right. So I'm now going to check and see what kind of questions we have. I've got a couple. So the Monte Carlo, I think I touched on this. Does it account for the current situation and future situations? Um, the Monte Carlo refers to the math that we do when we stress test your financial plan. Um, yes, is the short answer. Returns like what we're seeing are incorporated into the Monte Carlo because these are returns, frankly, that we've seen before. And Monte Carlo even comes up with, statistical numbers that have not occurred before. So it's a pretty robust tool that incorporates all of this. Um, so next question, are there ways we can vote with our money by investing in companies doing good in the world? Um, so this is a good question. What I'd say first and foremost, are there companies doing great things in the world? Absolutely. However, in this period of volatility, a stock is a stock is a stock. So if you're a good company, if you're a bad company, if you're doing good things or bad things, and those are all obviously subjective in the eye of the beholder, the stock market itself is going to dictate returns. So I don't think you're going to be able to hide out and avoid portfolio volatility by investing in some of these companies. We certainly have strategies that can incorporate your own personal values into your portfolio. Um, but again, unfortunately, I don't think they do much for you in an environment like this. Um, oh, this is a fun one. Cryptocurrencies seem simultaneously like smoke and mirrors and the way of the future. It's extremely environmentally expensive. What do I think about it? Um, so I think that 99.999% of cryptocurrencies are just absolute garbage. And I don't think they'll amount to much of anything. There's a couple that I think are doing interesting things. I think for the purpose of this conversation, it's worthwhile to kind of separate Bitcoin from the remainder of cryptocurrencies. Um, so conceivably, one of the purported benefits of Bitcoin is that it has a fixed supply of Bitcoin tokens that will ever be issued. Um, and so if you think about what's happening in terms of inflation, right? Hard assets and things you can't make much more of should tend to do well than paper, do better than paper assets. So in theory, and I'm sure somebody who is a big Bitcoin person would certainly make this argument, that it's a good store of value in a highly inflationary, politically uncertain time. So I can see that. I do watch Bitcoin daily. What I do find interesting is Bitcoin's well off the high. However, in the last week or so, Bitcoin has quietly come back up in price and is going up when the markets are going down. I find that extremely interesting kind of anomaly. So, in theory, anyway, that could be the case, but I certainly wouldn't go chasing down any other of the crypto tokens. Um, on the environmentally expensive, I'd also note that Bitcoin actually now gets the majority of its energy from renewable sources because it's so cheap. And so I don't think Bitcoin has that energy footprint. I mean, it's still using energy, obviously, um, but it's not quite as bad as it once was. Um, Looking off for more. Oh, my favorite subject. Thanks, Chris. Address the role of the Federal Reserve to the MEX. So yeah, I didn't even mention the Fed, which I probably should have. So the Federal Reserve, has this objective, sort of dual mandate of price stability and maximum employment. They are today focused on price stability, translation inflation. Um, Inflation has come down nicely from its peak in 2022 in the 9% range on CPI to kind of the high twos. However, inflation as of the end of last quarter really stopped declining and started to tick up ever so slightly. So the Fed has been very reluctant to cut interest rates, given that they have not hit their 2% target on inflation. Okay, and you see Donald Trump this weekend and also today trying to prod Chairman Powell into cutting interest rates to help stimulate the economy. First, what that says is Trump knows that he's killing the economy because of his tariff policies. And so he's begging the Fed to cut rates to help offset that. The Fed, as long as Jay Powell is chair, is not going to do that. They're going to hang tight. And by the way, if inflation's going anywhere in the near future, it's probably up as a function of tariff policy. So the Fed is going to stand pat, possibly could even raise interest rates depending on how bad the situation gets. Um, Now, I believe Jay Powell's term is up in May of 26. Um, I think this is a massive, massive risk to the sanctity of the US dollar and the treasury market. We are, and we have been known as the safest place on earth to park money in the treasury markets. If the Federal Reserve no longer has its independence, that's thrown out the window. Um, I can't stress this enough. This is possibly the worst idea for Trump to be able to put in somebody into the Federal Reserve who's going to make this a political game rather than an economic game. Um, and so we'll have to watch this very, very closely. I think the implications of that are a much weaker dollar. I think interest rates going up on US Treasuries and probably more inflation as a consequence of this. Um, so I'm very worried about this. In the meantime, Jay Powell has no interest in stepping down, nor does he have any interest in doing anything Donald Trump says, which I think is good for all of us. Um, all right, I'm gonna check for any more questions. Yeah, so just a question, are we making changes to our current portfolios? Yes, we have been. Yes, we will continue to do that. The way I would think about this, and everybody's portfolio is a little bit unique, so I can't be exactly specific. Um, we have added things like precious metals. We have, reduced or eliminated exposure to things like longer dated government bonds. When you're in a stock bond mix, let's say you're in a 70-30 portfolio, for example, we will manage changes within the 70 and we will manage changes within the 30 if that's sort of the profile that you've agreed to. What we won't do without a conversation or unless you're in one of our more flexible quote unquote rowing type of portfolios, we're not necessarily going to change the allocation out of a 70-30. Um, not by our own discretion. Now, in talking with you, if we end up wanting to do that, that's certainly obviously on the board. We can definitely do that. Um, See if we have any more. Okay, I think I don't see any more messages. So a big thank you for you all joining today. I hope you found this informative. I know I didn't cover everything, but there's certainly a lot going on, and I wanted to kind of keep this within an hour, which looks like we've successfully done. If you work with us currently, feel free to reach out with any follow-up questions more specific to your situation. If you don't work with us and you'd like us to kind of give your situation a second set of eyes, we'd be happy to do that as well. You can visit us, of course, at hightowerstl.com. And with that, I thank you all. I hope you have a great rest of your week and take care.